Hello, everyone. You're joining this morning our session at the SOSV Climate Tech Summit with Goodwin Procter. The name of this session is Preparing for an Early Stage Climate Financing. So with that, I'm going to hand it over to David and Andrew to get things rolling. Thank you.
Great. Thank you so much, Ned. And thanks to the SOSV team for having us back. We've now done this a couple of years in a row, and it's just great to be back here. So I'm Andrew Sparks, and I'm from Goodwin Procter. We're here to talk about preparing for an early stage climate tech financing. I have my co-host here, Dave Brekke, who's the co-chair of our climate technology practice at Goodwin. And so we can move towards introducing our panel. So once again, I'm Andrew Sparks. I'm a partner in the technology companies group at Goodwin Procter. I'm based in San Francisco, grew up here, and have focused my practice on working with startup technology companies and investors. And particularly, I've done a lot of work in the climate and sustainability technology space. I'm the co-chair of our climate tech practice here at the firm, where we have about 100 lawyers all working collaboratively in this space. And so I'll kind of let our panelists introduce themselves here a bit, but I'll just briefly say here who we have in the room. We've got Dave Brekke, who is the co-chair of our practice. We've got Sanjeev Mankotia, who's the CEO and founder of GaeaStar. And we have Kira Noodleman, who's a partner at B Partners. And so I'll let folks introduce themselves. Maybe Dave, you can go first, and then Sanjeev and Kira.
Yeah, sure. Thanks, Andrew. And thanks to the SOSV team and our panelists or everyone for being here. This is going to be hopefully fun and interesting. We're going to, as Andrew said, and the organizer said, we're going to try to keep the presentation short and kind of keep the Q&A lively. We always find that's more interactive and engaging and probably fun for people. Yeah, and so I think anyway, I'm Dave Brekke. As Andrew mentioned, I'm the co-chair of our climate practice here. To kind of echo what he said, kind of our native territory is startup investors over the life cycle of that type of company. So as you all know, there's a million different challenges startups face, and we try to help with all of them. Kind of leveraging this big law firm we sit in to address any of the needs that might come up, and they kind of always do. The measure of our practice is, are we really helping climate startups make a difference? Are we really facilitating that impact? Are we connectors for these folks? Are we helping them with their, technical legal issues? Are we helping them with strategy? So it's really fun to get to talk to you a lot at once. It's really fun to be here with a bunch of, climate needle movers. And great to talk to you all today. I'll pass it off to Sanjeev.
Thanks, Andrew. Thanks, David. My name is Sanjeev Mankotia. I'm the founder of a company called GaeaStar. Our focus and vision is to eliminate plastic waste, specifically single-use plastic waste, by using distributed manufacturing and material science. Hand it over to Kira.
Awesome. Thanks, Sanjeev, and thanks, Andrew and David. Great to be here. I'm a partner at B Partners. We are a pre-seed focused venture fund, so love to be the first check-in. Have invested in companies out of indie bio like New Culture in the past. Really love bringing partnership and collaboration with our founders beyond just capital. And at the pre-seed, that means a lot of support around how to go from zero, pre-product, pre-revenue, all of that to one. So the semblance of some early product market fit. And when I say deep tech, what we mean by that is that we believe machines are winning and they've been winning for a while. And in the case of biology and climate, what that gives us an opportunity to do is defy the laws of nature. And at B, we especially look to disrupt food, ag, industrial markets. So love deep tech and love bio, and I do a lot in the deep tech community at large. Organize a group called Women in Deep Tech, and recently started a podcast called Pathfinders about deep tech. So very excited to be here.
That's great. Well, maybe we can step into kind of our agenda. Dave, maybe you can chat about that.
Yeah, for sure. So I think, as we said before, we're going to have a little bit of a talk from Andrew and I about some of the things that we help companies with. Hopefully we are touching on some of the burning questions you might have for your attorney, and you can use this as free legal advice, or, you know, kind of to prime yourself to think about things you can be addressing strategically on the legal side. Then we're going to turn to something that is probably going to be really interesting as well, which is, you know, talking with Sanjeev and Kira about a few questions that, you know, we're going to ask them that hopefully be applicable to you know, your roadmap and everything that you're going to see around the bend. I'm interested to hear their feedback too. We haven't scripted it, so I'm looking forward to that. And there's a hidden agenda part 3, which is the Q&A. Again, we like to keep that really healthy. And so again, a plug to what was said before. Please do use the Q&A, the chat feature. We'd love to get that pre-populated with stuff to talk about and make sure it's super relevant for y'all at the end. We're going to leave plenty of time for that. Also, I wish they had the reactions feature on this one. I don't think they do, because I know Andrew really thrives on, you know, emoji-based feedback from others. So we'll have to make do without that this time, but can move on. So I think the first thing from our side that we want to share in terms of legal issues, these are kind of the things that we're answering for almost all of the clients in climate tech. You'll notice that a lot of this overlaps with kind of any old startup, but there are nuanced differences almost in every single one when you're in climate tech. Kira and Sanjeev can talk about the different aspects of the roadmap and timeline, all these things that affect how you might answer some of these questions. If you're a startup, you kind of start from the cookie cutter response, but then you kind of like challenge the assumptions because climate tech is a little bit different. So one thing, you know, I'm just going to tick through these here on the left side. There's definitely a lot of stock pitfalls when we start working with a company, especially if we haven't formed them from the outset. One of the things we see often is that folks have, you know, there's a team, right? It's usually not just one person, and having an equity plan. That's not just an idea in your head, like the normal meaning of the word plan, but there's actually a piece of paper that is an equity plan, and it qualifies you for a bunch of exemptions and streamlined ways to get your team equity that obviously align everyone around creating a fast-growing company that's going to eventually have a big exit. So having an equity plan, having a lowercase plan, the plan in your head up front, is really good too. I want to be at this equity level. I think I need 3 other people on the team to be at these respective equity levels. That's my kind of lowercase plan. But then when you actually do want to give them the equity, you adopt a formal plan, which is a piece of paper. You go through the steps to get them their equity. You do it early on enough that they can do it at a cheap price. And so once you're at that point, that's the time to have a conversation with your attorney, and you can get that done really efficiently. The label of the column is pitfalls. So we have seen folks call us years later saying, hey, everyone's been on the team for years, and how do we get them their equity retroactively? That's we like to say an ounce of prevention is worth a pound of cure. So definitely have that conversation as early as it crosses your mind. A3B elections are a little bit famous. Maybe you've heard of them. There's a million articles on how this has gone wrong, but it's a special IRS rule that allows you to pay tax on your equity all up front when it's kind of par value, when all the value in your equity is prospective, right? As opposed to paying tax on your equity as it vests. So ideally, you know, you'll get your equity up front, you pay a fraction of a penny for it, and over time the value dramatically increases, right? So you paid nothing for it today, it's worth billions of dollars in a few years, and you're investing in that over time. By default, the IRS would have you pay tax on that as it vests, but you don't have any liquid in that because you haven't sold the company yet. So that's the default rule, is that you would pay tax on that equity as it vests and gets really expensive. So the 83B election says, no, tax me on all this on day one, when the tax is 0, right? And there's a 30-day time limit. It's hard to adjust it. It's actually impossible to adjust it. There's a few workarounds that are not great, that have their downsides, I would say. So 83B election is really important. You've all heard of them. It is true. It is purely administrative, but definitely got to keep that in mind as you're issuing yourself and your team equity. Number 3 here is granting stock at fair value. So what is fair value? When you're first starting a company, you can call fair value that fraction of a penny price. And it's great to get the team stock at that price because, you know, you actually don't have to come out of pocket for that money, for that stock. But then as you grow the company, as you gain revenue, as you take on investors, the investor is saying the company's worth $10 million or $20 million, right? Now, what is the fair value of common stock, right? You have to take some position that's not worth, you know, par value anymore. It's got some value. Usually you use a third-party 409A valuation firm. A lot of times your cap table management software company has those on the cheap. Those are getting down between $1,000 and $2,000 I've seen. Sometimes they're free with your subscription for other things. And there, again, an IRS rule that says when you're granting team equity, there has to be at the then current fair value. So you can't just go back in time and say, I'm going to give folks equity when they started 3 years ago. I think there's some historical huge corporate lawsuit on that. I think it was it Enron, maybe, Andrew? Anyway, so yeah, there's a big history on that, but you have to grant equity to your team at the value at the time you grant it. So there's no going back in time and backdating the price on equity of the team. Big IRS penalties for that. And so you want to keep in mind to grant at the then current 409A valuation. We've seen folks do that incorrectly. It's possible to clean up if you catch it in the same year, but it has its downsides to do that as well. And then allocations, thinking ahead about the way you envision the org chart of your company, in the next 12 to 18 months, or maybe 24, what does the org chart look like, right? Is it me plus 3 people? Is it going from 3 to 20, right? And how much equity budget do we need for all those people to be appropriately situated on the cap table? You're going to be wrong sometimes about, hey, this person was a VP level person, this person was a director level person, and you build that in as part of your margins there. But you want to you do want to have a vision for what does the option pool look like, overlaying with what does my organizational chart look like, so that people are all in the right place and the team can really hum in terms of aligned interest.
That's great. And something high level that I just wanted to touch on as well is that some of these rules are fairly counterintuitive and people aren't necessarily familiar, particularly if you're in a climate tech company and you've been, working in a national lab like, Berkeley Lab, or maybe you've been at a research university, you're in the lab at UC San Diego or any other university, and you've been really focused on this very complicated technology, and then all of a sudden, you're starting a company, and some of these rules are pretty counterintuitive, and so we just want to sort of sensitize people at a high level about some of these issues, and of course, happy to follow up. But next thing that we see kind of go wrong a fair amount for startup companies is just really inadvertently violating employment laws. And one of the biggest issues here is around, minimum wage rules, and just making sure that everybody on the team is earning, at least minimum wage or getting some sort of salary for the work that they're putting in. There's this kind of common misconception around startups that, everybody works for free until you raise money, and that may be, 2 years down the line. But, if you've done that, then you have basically 2 years of, wage and hour claims accrued against the company. And that's pretty problematic. That's ultimately kind of unfortunate for those service providers who are trying to help build the company. But it's also, a legal violation that you want to try to steer clear of if you can. So just paying attention to those minimum wage rules, even where people might volunteer and say, hey, you don't need to pay me, don't worry about it. It's still something that you should keep an eye on and make sure that you are paying folks. And sort of a similar vein here is around worker misclassification. And this is something that we see a fair amount as well, which is that, hey, the company doesn't have any employees, everybody's a consultant. And that, doesn't really work. There's lots of state and IRS rules around who is properly an employee, who is properly a consultant. Is this person operating in a key position of the company? Is the person, the CEO or the CTO or something like that? In which case, the rules would definitely indicate, this person's an employee. And so therefore you should pay them a certain wage, and there should be withholding on their wages and all those sorts of things, versus somebody who is a consultant who might truly be, outside of the business, not related to what the company is working on. There's no control over what they're doing. This is like the plumber or something like that. It's not, your team of engineers who are building the product. And so just keeping an eye also on who is actually an employee of the company versus who is a consultant. We see companies sometimes get into hot water over this. And particularly, again, sometimes folks working in climate, working in deep tech, they've spent the last 10 years in a research lab rather than kind of touching on these legal rules. So just wanted to try to sensitize people to these topics a little bit.
Yeah, and I would say
next slide.
both of the points in this category are in a perfect world when everything goes right. These are kind of ministerial cleanup matters that you wish you could have avoided. But in an imperfect world, in a founder breakup situation or an employee breakup situation, these things kind of tack on and make it really hard to get past. So although Andrew, you and I never see founder breakups or early employees.
Never
It
happened.
doesn't happen. Yeah, it's always really amicable when that happens too. Moving on to the next one is protecting IP. Obviously, this is super fundamental for early stage companies and companies at all stage. And I think this is kind of one of the main tenets that an investor is expecting to not have any issues with when they write their first check. Is the assumption is that your company was established well, the cap table is what the cap table says it is, and that the company has all the IP it needs to go do its business, right? Those things are the risks that early stage investors don't take. They take plenty of risk on team, market, in engineering, and everything else, but not on, does the company actually have the IP to go do the business? And so one of the things that you definitely see companies needing some cleanup on before the funding is able to come in is making sure that everyone who's touched contributes to the company's intellectual property has signed an IP assignment agreement. And I think sometimes I see folks who have kind of just said, we're all working this together. Obviously, the IP is owned by the company, but you do need a piece of paper that says that. Most forms you'll find off the shelf will have the language that says, I hereby assign everything I'm doing for the company to the company, and a bunch of boilerplate language to support that. If you've missed that step, go back and do it. The part that can get really hard is if you've had a team and they've all been contributing, 2 people have left, and now you have to go back and chase down people who aren't necessarily taking your emails anymore to get that piece of paper signed. That's a harder one to do. Often they'll say, great, I'll sign that for you. How much money will you give me? And then that's a different conversation than you wanted to have. Good hygiene, super easy. Anybody who's working on the company. And the other thing that I was going to see that reminds me is, in this sense, IP doesn't mean registered IP. Doesn't mean just your patent. Doesn't mean just your trademark. Doesn't mean just your domain names or other things that you might register with the government. It means napkin sketches, business plan, broadly IP, right? So anybody could say, I worked in the company, I was your consultant, I never signed anything, and your core go-to-market plan is my idea, right? That type of thing is what we want to capture with when I say everybody who contributed, I mean even those folks too. So the plumber, Andrew, maybe didn't have to sign it, but Andrew, what were you going to say there?
And yeah, just as an example, we had a financing and we were trying to close the financing, and the company had missed having a few people sign these form invention assignment agreements. And when we reached out to them to have them sign, it was a conversation of, how many thousands of dollars are you going to pay me to sign this thing? Because the other person was not very friendly with the company, and they detected that they had leverage at that point. And so, it became this weeks long back and forth, them asking for tons of money, and it was holding up the company itself getting really necessary funding. So just something you'd rather avoid if possible.
Yeah, better to have that conversation when there's no money on the table than to do it in the context of a raise or an exit, or worse, an exit. Yeah. Next one in this category is utilizing NDAs. NDAs are, essentially, we're going to be sharing information either from one person to another or from 2 people to each other, right? Saying everything I'm sharing with you is confidential. They're called NDAs, which means non-disclosure agreement, but also in them, you'll also find non-use. So it'll prevent them from doing things like reverse engineering what they've received from you, or using it for some other purpose, like to compete with you. So the NDAs is definitely a good tool for the early industry partners you're going to be communicating with. Obviously depends on whether the nature of the relationship. Is this a commercial partner? Is this a supplier? Is this a potential investor? And so, making sure you're getting protection on the IP that you're sharing with others. One kind of nuance with patent is that if you shared information that you later want to patent, right? If it's under NDA, you haven't started the clock. So there's a time limit after you've disclosed something publicly without confidentiality that you can actually go back and patent it. So if you're sharing anything that you might eventually want to patent, keep it under NDA, because then you haven't started some kind of clock and when you have to go file. So NDAs are important. Usually they're pretty standard form. You shouldn't spend a lot of time negotiating them because you see NDAs all around. They're usually all the same, but definitely getting those when you're sharing IP. The NDAs are not a cure-all though. It's hard if you're sharing your secret sauce with someone who could just sue you into oblivion. Doesn't give you much protection, that piece of paper, right? So definitely you want to, depending on who the counterparty is, do they have a strong interest in their reputation, like a VC fund who's invested in a bunch of companies who all love them, right? Like Kira. They don't have a practice of stealing folks' IP because they wouldn't have a business if they did that, right? So you can be a little bit more lax with folks who you have a good reason to trust that they're not going to steal your IP in the first place. But some counterparties actually don't have such a great reputation or don't have such a strong interest in not gaining their reputation. So definitely want to pair back if it's somebody who actually has the capacity to steal your idea and run away with it. Keeping that in mind. So it's not just about the piece of paper, it's about who the counterparty is. And the NDA doesn't just give you this like magic wand to make sure no one ever steals your IP, even though it's definitely a good thing to do. And then the third one's the data room. So this is making sure that we've gotten all our IP assignments, we have all of our NDAs in place. Are they organized so that we can confirm the same to everyone who invests in the company? We can feel good about that all that stuff has taken place. This is also a kind of a pro tip or hack for completing your diligence for your fundraising on time. A lot of times we sign the term sheet for a fundraising run, everyone's high-fiving each other, and we want to close tomorrow. But the investor does need to see all the pieces of paper in your data room. And if it's kind of just like, file 6686.G6, and you haven't actually organized the data room, it takes a long time to sift through that stuff and check these boxes. So, and it's easier to do as you go, right? It's a little bit more difficult to do all retrospectively. So kind of start that practice early, get a good folder system for your data room, name the files well, keep them all together. And that way, when you open up the data room, you can turn around that you can shorten the time between term sheet and closing. And that's really what we like to see.
Yeah, absolutely. And a next bucket of things that we see and ways for the companies to think about getting prepared for early stage financings is just at times inadvertently folks will violate securities laws and make kind of mistakes. And so one of the biggest things to note is just that issuing securities in the securities industry is one of the most highly regulated, industries and processes in the world. And so there are lots of rules that you want to pay attention to when you are thinking about raising money. And so number one thing is just around kind of the private offering rules. And any early stage funding for a company is going to be generally a private offering. The counterpoint is sort of the public offering. That's the IPO. That's what you see, in the news. Big companies going public. That's a very long, drawn out, expensive process. You have a 300-page IPO prospectus that takes lawyers months to draft. That's different. That's a public offering. For the private offerings, we're operating under a different set of rules. And one of the most important things is just avoiding what's called a general solicitation. And that means, avoid going out, posting on social media or making kind of broad offerings to try to raise money for the company, posting on Twitter or something that you're raising money at a certain valuation for your company. These are things you absolutely want to avoid because that's a securities law violation, essentially. So keeping that in mind. And then another issue we see is just, folks using templates, and templates generally are a very good thing, particularly if you get your templates from a law firm, or there are some online, software services as well that can provide some good templates. But you want to avoid just finding random forms on the internet. And this is something that we see a fair amount of people kind of exercising self-help. Maybe they kind of come to us later and they have some really wacky forms of, NDAs or employment agreements that aren't applicable or don't, cover kind of major things. So making sure you're sort of sticking with the tried and true is a good idea. And then last topic, which is near and dear to our hearts and probably something that Kira sees a fair amount of and can advise on as well, is just, avoiding kind of breaking your cap table by giving out too much equity to either people who aren't helping or somebody who maybe came in initially for a very small check, but then got, a third of the company or half the company for very little money. These are things that can break the cap table. And the thing to keep in mind there is that it takes a long time and a lot of effort to build a technology company, and particularly in the climate space where we sort of over-index towards hard technology, manufacturing, things that take time, machines to build. And so it's going to be a long road, and you don't want to sort of mess things up early where you give out too much equity early on, either to somebody who just leaves the company, or even, an early investor who comes in with that really attractive, $100,000 check, but wants half the company. That's just something you want to try to avoid as much as possible. So yeah. I think we can maybe stop the discussion there on the slides and move in towards our panelist discussion. And I see some questions floating into the Q&A, and we'll definitely get to those as well. We had a couple kind of initial questions that we thought we could go through just to get the conversation really flowing here. And so we have our wonderful panelists, Kira at B and Sanjeev at GaeaStar. And so, something that I wanted to ask to Kira is just, from where you sit as an early stage VC, can you talk, at a high level, sort of summary fashion about the process of raising money, things like thinking about, um, customer discovery, investor readiness, all these sorts of things.
Yeah, absolutely. So in terms of just the broad strokes of raising money, I think at the start you want to understand the stage you're going to be raising at. So if I'm thinking of kind of SOSV stage, typically this is pre-seed seed companies. And so pre-seed in particular, like your pre-seed stage, if you go through an accelerator, sometimes that accelerator actually takes you to seed stage. There's pieces of the equity of how much you raise. Like, for example, an accelerator might take under 10% of your company. But your first round of capital, no matter who it's from, you probably don't want to dilute yourself past 20-25% to give you a broad stroke. So anyhow, point is, any round of capital, I would actually say the same thing. You're between 20-25% dilution. And that's true at the pre-seed. And at the pre-seed, where I personally play, we talk a lot about it being a team and a dream. And so, like I was mentioning earlier, it's very typically pre-product, pre-revenue, pre-product market fit. I mean, we are making this bet on the 1 to 3 people in front of us and sort of their unique, we call it problem founder fit, but who they are, why they were made to solve this problem. And then we're also looking at really big markets. And just by nature of how VC works, on our side, we're looking for these massive 10x and beyond returns. So in deep tech and climate in particular, because those businesses are even harder to build, we're looking at markets that are a minimum of $20 billion. And then ideally it's a platform company. There might be adjacent markets that add to that. So really, really big markets. And there's other forms of financing, right? If that's not the kind of market you're going after. And I guess one other thing too about fundraising before we get to investor readiness is, before you want to raise money, you want to try out every single thing you could possibly do, that like every assumption you can before you ask for money. And then when you're flip and you're ready and you're like, you know what, I I could put some capital to work and here's where it would go. You want to be ready to essentially pour gas on your business and light a match. So, I mean, that's really the shift you're doing when you show up to these conversations. And I think there's this adage about preparing to raise of just this idea that you're always fundraising. So if I bump into you for 2 minutes at an event, if you said something that was this dead on fit to our thesis, that could turn into me eventually writing a check to you. So there is this nature of like, it's human. You're always kind of doing it. And at the same time, if you're going to go out to try and raise a round, I would say for any round of capital, you should probably plan on 100 first meetings with unique investors. So that's a lot. So how do you even get to that list? It's actually, this part of fundraising is actually quite easy to do, which is do your homework online. There's a lot of lists. I'll tell you, NFX Signal has a really great database of all kinds of investors, stage, thesis, and so on. So like truly do your homework, because then you can really reach out to someone like me, or at B, we have a website. Anybody can submit us a deal and we'll respond. But the point is, like, the closer it matches to our stage and thesis and so on, the more likely you are, right, to have success. It's just very straightforward, but this part gets missed all the time. I kind of joke that I think VC founder interactions are like platonic dating. You're dancing. You want to share the right amount of information without oversharing, and you want depth, but you don't want someone to lose where you are. So there's this really interesting zoom in, zoom out that I think you're constantly doing as a founder. And hopefully the investor is participating with you to help with that. And just to round out a couple things here, I mentioned this concept of problem founder fit. I think this piece of like, what's your earned insight? Like, why were you made to solve this problem is a really important element for the way I underwrite deals. And honestly, in that context, it's actually amazing if you could almost teach the investor something they didn't know, because you're trying to show something about where your edge is in differentiation. So there's this piece there, like in the case of New Culture, they could express the casein protein in a way others couldn't. And this problem founder fit, Matt, the CEO, he's from New Zealand and the dairy capital of the world, and really had studied the climate impact of dairy. Okay, and the last thing I'll say here is when you show up, you got this problem founder fit, but what you're really trying to do when you're asking for money is define really clear milestones of what you're going to do with that money. I mean, there's a literal execution basis. You're going to hire a team, you're going to do X, Y, and Z, but what are the milestones, the inflection points? And in deep tech and climate, this is really important because you're likely pre-revenue by a Series A. I mean, you really need to be able to, in all kinds of ways, explain your technical progress along the way. And essentially what you're trying to show is like early product market fit. But again, that might be said in technical milestones. Like our titer is this amount and it was this before. Our productivity is this amount. This compares to production scale way down the line. So happy to share more, but I'll pause there.
No, that's great. Really appreciated that insight, and even just thinking, for a founder, how to plan out for these, 100 conversations that they may need to have and how to attack that. Really, really helpful. And so Sanjeev, kind of turning to you, as a climate tech founder with a really amazing company where you're 3D printing these clay cups, and doing a lot of great work in distributed manufacturing. Can you talk about your, journey as a founder, starting the company, raising money and all that?
Sure. Thanks, Andrew. And, I would say I'm not maybe the conventional founder. I'm actually on the second half of my career versus the first half, a little bit older than your traditional founder. A trained engineer, worked as an engineer in the bicycling and so the automotive industries as an engineer. Then I got seduced by finance and went into banking. Still use the same math skills, but spent a lot of time there. And this idea of this company has been around in my head for a long time. It was really related to my passion for nature and being outside. But the journey was really, from the inception of an idea, how do you transfer it into something that can make an impact? And the idea could be great, but the impact means it has to scale properly, which means it has to be a good business. And this is where the investors are also looking for that aspect. So for me, this is maybe sounds cliche, but working on things in the garage with caulking guns and things like that to figure out the technology. And really what I was trying to do was um, figure out how to make eggshell thin vessels. And the idea was that, hey, how do I make eggshell thin vessels with naturally occurring minerals and materials? And this is the idea of the clay cups, and being able to utilize them and just, throw them away because it's ultimately made out of dirt. And that technology didn't exist or doesn't exist to be able to do that. So kind of formulated that. But the initial form of funding was my own pocket. I kind of started it and worked on it in the garage and spent some money. Then I needed to hire an engineer. I had to pay that engineer myself. And I agree with both Andrew and David that, you have to be very careful that you're following the employment laws of the country or the state you're in. So it's really, really important to do that. And those comments on those other two slides that you guys presented, yeah, you have to not get deep end on all the IP and everything, but you have to basically understand what it is required to commensurate with the size of the company you're at or the stage you're at. So whether it's a template or actually talking to a big law firm, it depends, right? So, but the concept and the idea should still be there that you need to tick the boxes on these in the correct way. So funded that way, and then got a little bit bigger. We needed more capital. Then you start asking friends and family, like, hey, I'm doing this kind of thing. And a lot of this is, based on handmade prototypes or just a couple PowerPoint slides. And you get a lot of feedback, and that helps refine your pitch and like, what exactly are you trying to solve here? And most of the feedback would be like, this doesn't make any sense. And you have to kind of really go back and start thinking, and how do I make it sense as an actual business? And that starts taking traction. You'll go and Andrew knows, because I work with you quite a bit, probably 50 to 100 iterations of each slide deck. And to Kira's point, talking to 100 investors, that could take 7 to 12 months to talk to that many investors, especially in today's climate. But, the momentum starts. There'll be a lot more people who don't connect to what you're trying to do, because not that your idea is bad or doesn't work. It's they're looking for something else. It's not their thing. And I completely agree with Kira's comment. It's like dating. And actually, maybe I share with the audience an idea of dating. It's like a dating app that's like, between investors and founders that just have a small profile, like a Bumble thing. You just swipe left or swipe right. So if anybody wants to take that, I just need a, acknowledgement that I came up with that, right? But it takes a long time and a lot of conversations. And all of these conversations, I think, are helpful because they help tune your message. And you have to be really, really succinct and sharp in what problem you're trying to solve and how it could scale and how it could be a profitable business. And from an investor perspective, trying to put yourself in their shoes, they are looking to invest that's going to, 10x, 20x, 1000x their money. And how does that happen? And there has to be a roadmap to be able to show that. So yeah, the momentum starts, then, you get into the pre-seed type of thing. Some notes I made, it doesn't need to be a price round. It could be initial investors usually would like to do a safe. There are different types of safe, but you get, 50,000, 10,000, write a safe note. Keep in mind that these also have implications to your cap table eventually when you do a price round. But I think on a pre-seed, generally a safe sort of thing, financing would work for climate tech or hard tech type of companies. We've done that too. Get non-dilutive funding from government grants, and you have to apply. You have to apply a lot. There's a lot of money out there. but it's not easy to get to. So it's just a matter of being consistent and applying for a lot of this work. Then at some point you'll get to the next stage where you've developed the product. It's kind of getting out there. And then you raise the next round. And at some point a VC will say, okay, this has to be a price round. And then, you've got to get the lawyers involved and they will take some chunk of that investment, right, Andrew? And then you have a price round, and then you're on the journey there. But you could see that this builds a community from your investors, from the attorneys that are helping you, because they help introduce potential investors to you too, because they're working on both sides, right? And I think last comment is all of this happens on a great amount of transparency and trust. And if that's not established with the people you're talking to, then you're going to have a lot harder time to move forward with your company. Handing it back to you, Andrew.
Yeah, thanks for continuing the dating app analogy. I think you've identified the most fun part of this conversation. So I'm going to keep that going. I try to have our practice, Andrew and mine, be kind of like the hinge, right? So we have all these friends on the company side, and we have all these friends on the investor side, and we analyze both in our mind, and we try to make a good match. So you're friends of friends, and hopefully that's a good place to start with. So to keep going even further, I would ask here. I'm going to combine questions just in the interest of time here, because I know we wanted to keep some time for questions. You're getting, I imagine the converse is true. You're getting 100 inbounds for every one deal you make, or more. I'm not sure where in your filter you're at 100. Probably it's at the top. It's more than 100. So what does B need to see to swipe right, or whatever the analogy should be? And then to something Sanjeev mentioned, a lot of companies in climate are getting more non-dilutive funding, government grants or other research money, than maybe traditional startups. And so how does that factor in? Is that something you think, oh, this is great, this doubles my money? Or is this something, oh, they're going to do a side project that may be distracting? How do you think about that? So what makes you go from nice to meet you, love your idea, to like, yes, we want to move forward with the process? And to how do you view non-dilutive funding in terms of what that brings to a company you're looking at?
Yeah, great questions. Well, I've got some specific ideas, but at the very starting point, full stop, I mean, I have to believe and feel that your vision is going to change the world in a really significant way. I mean, that is genuinely the perspective we're taking with investments. And when it comes to like, so many good questions too. The non-dilutive side's great. I mean, we used to see government funding as this secondary revenue stream that sort of, I don't know, we were almost neutral to it. It's certainly money coming in, but it wasn't going to move the needle on the private sector commercialization. And we've really shifted gears. We look at biomanufacturing, we look at traditional electronic, mechanical manufacturing. All of these areas that touch the physical world have a ton of non-dilutive funding, whether it's DoD, DARPA, Biomate, et cetera. And so the point is, these days, it's such a competitive advantage. One of our companies literally has matched VC dollars to non-dilutive funding dollars. And it's just like, I don't know how we can invest in companies that don't take advantage of that. And just a quick note there is one way that they were able to do that was they've, become friendly and from a collegial perspective, close to some of these policy makers that are defining budgets of where that money should go. And so they're effectively becoming this poster child by becoming educators as to what the future could look like. So I think it's hugely important, something we really look for. And other conditions we're looking at, and by the way, you asked about some numbers. We see 3,000 plus, maybe even closer to 4,000 deals a year. It's been rising. And we invest in 6 companies a year. So it's a really, really, really small amount. And when it comes to bio and climate in particular, we're looking for 3 things. One is there simply a better bio product that you're creating? So is it, like, for example, in the case of Sanjeev and his company, a single-use plastic replacement, like, could he hit price parity? Is it on par with existing plastics? Does it have some superior functionality that actually you cannot get in traditional plastics? So like this concept of just there is a meaningfully better product that you can actually create. And also, is it cost competitive at scale? We don't expect really most of these innovations at pilot scale or, to be cost competitive, but that price parity element is incredibly critical. And having a TEA that shows us today kind of that how you get and step up on that ladder to get closer to price parity. And, depending on the solution, maybe you can even beat it. Some of these renewable feedstock solutions, you can get to you can also get to carbon negative. I mean, it's amazing what you can do, but you got to tell that story. And also you want to be able to, and we've seen so many, challenges, failures in this industry from giants that have raised IPOs and public companies where they haven't necessarily fit into the existing supply chain, where they're developing, like in the case of Zymergen, you could say their biofilm that they produced for phones, that the buyer on the other side didn't necessarily understand. It wasn't like it was a one-to-one of the product spec that they created to what was already being used. There was a lot of education and that was created friction for them in their supply chain. And so, you don't want to be limited in growth in that particular way. So those are kind of like three big things we look for on top of the non-dilutive side. And I'll pause there.
Yeah, that was a great response, and I think we might move towards some of the Q&A here, just so we have some time to address some of the great questions that came in through the audience. And there was a really good one here from Jed Wheeler, which is one of the upvoted questions. And I think this one goes to Kira, and I'll just sort of summarize and abstract this a little bit. But how do you, as an investor, think about technology that's so unique and specialized and complex, and like some of these deep tech and climate tech companies that we're working with? I mean, the science is so challenging, right? Some of these nuclear fusion companies, right? The science is so hard to kind of really truly understand. So how do you approach some of these types of companies and technology? How do you sort of short circuit that and get ready to invest?
That's a great question. I think that's part of what makes deep tech investing fun, but incredibly challenging because it is my job to learn something new every single day from not just like online, but from the smartest people out there innovating in the space. So one, it's no matter your background, that's challenging. I mean, gosh, two, I stay close to, we call them engines of innovation, but like IndieBio, Activate, Nucleate, all these different groups that are constantly looking at the latest research. I'm close to various professors that, their PhDs have started companies, go really deep with them. I personally am really open about, like, well, I'll write up an investment memo and show them how I'm understanding their technology, showing how I'm understanding the economics, like what markets that they could go after, like not just the market size, but the market penetration. So I'll always try to pair it to this economic view so that they understand, because on our side, we can fall in love with your technology, but it's not enough if we can't apply it and see how you can apply it to an end market. Um, so I guess the short of it is we write theses, we publish them on our website online, we talk about them a lot, but the point is we're constantly like evolving them with that founder. And for example, something like continuous fermentation, there's a company called Pow Bio we invested in. I didn't know what that was until I met these guys. I knew about batch fermentation, but gosh, what if you could constantly have a batch of soup you're cooking instead of stopping, taking out the ingredients, starting again? Like there was just these basic ways that we needed to be able to tell the story internally, and then me as the primary point of contact, the lead investor, I went a mile deep. And so the amount you can help your investor tell that story, the more easily they can also evangelize in their deal room.
Yeah, that's great. Really helpful. A lot of the technologies in this space are so complicated. How do you get people kind of on board for that journey? How do you help people understand? Sometimes also there are kind of experts who can help weigh in and help VCs evaluate and diligence certain technologies as well. So I think that's something we see every once in a while. But another question here for Kira, and I thought this was pretty interesting from the audience. Apparently this person has a deep tech manufacturing startup, and they have a product prototype, pre-pilot production, and they have signed LOIs with customers, worth millions. And so is this something that you consider as an indication of product market fit? How do you kind of evaluate those LOIs maybe for other companies thinking about this? And sort of, what stage do you feel like this startup is at that point?
Yeah, great question. So on one hand, LOIs are so important because they signal there is some meat on the bone of the commercial interest that is written in that LOI. Like that's the value. I'd say the downside or just the skeptical view might be, well, that company needs to get to a certain point of tech readiness. Like we have companies right now negotiating LOIs with really big companies like Danone, like Kraft Heinz. And until this company can get to their pilot stage and show essentially productivity, that their fats come out of their own biomanufacturing tanks, until they do that, they're not the LOI basically means nothing. So you want to almost like there's two equal sides to it of just it is a signal. It's really important. We're trying to assess customer readiness just like you are. That is a really important point to prove something. And and also is the case with bio. There's so much you can't know until you actually do the science and you scale up if you're trying to get to pilot. I don't know, that might be 1,000-liter tank, but if you're more like bench scale today, there's a lot to do, right? To be technically ready to actually biomanufacture at that scale that company wants to buy from you at. So it's a great leading indicator.
Sanjeev, I think your company might be facing a similar position, right? I mean, you guys, but I think one thing I wanted to call out and ask this question to you is the thing you're selling. I mean, a lot of startups are selling something that's new that the users have to get used to using or incorporating into some other process, right? But in the end, you're selling cups. It's really easy to tell someone, here's how many cups people use, right? And like, here's how cups are used and they have use utility. It's super clear the end result. So that maybe takes one of the risks off the table, right? People know how to go like this. How does Kira's response kind of like align with your experience?
Yeah. So first of all, we're not a cup manufacturer, right? That's just one of the widgets we make. We can make a lot of things, and we're focused on vessels, right? So anything to go vessels we could do with our technology. And really our IP is how to make these things using a natural material. To Kara's point, yeah, we have those LOIs also, and they generate, and there's also actual sales that we have. So you need a combination of things. And for us specifically, we have LOIs from the very, very large sort of corporates and kind of blue chip national, kind of level companies. They take a long sales cycle. To be able to deliver to them requires a different level of logistics and supply chain and whatnot. But you could still prove your product market fit by regional customers or slightly smaller. And that's what we have done. So we work with, more regional places. Their decisions are much quicker. Their margins are better. They're not going to squeeze you for like the last, quarter of a penny. So start working with them. That market itself is big enough for a early stage startup, being very focused. And that's why we are focused on just cups. We're not making the sweet green bowl yet, or we can, but we're focused on that. Not only that, we're focused on one size, because when we talk to our customers, they're like, if you're going to make one thing, make this and perfect it. And that's what we're focused on for our sake. Mind you, that in itself, it's a huge market. If we could sell and capture, significant market of that, then we'll be all billionaires. But it's being very focused on that. Also having the forward-looking thing, like, yeah, we want to get to that scale where we are working with a, national level or international level company like a L'Oreal or Johnson and Johnson, or even Starbucks. It takes time, but if they're giving you indication of the LOI, that's great. But you also need to show, hey, I'm also doing the grassroots type of thing. So it's an amalgamation. It's not a one one thing that's going to be the home run, and all of a sudden everything works. And you'll be surprised, and as you go out and start working, you get customers that you never thought would be your customers. So it's really, really interesting, and how the outside world starts looking at you when you're producing a product. We get interest from Kenya and Nambia, because they have regulation there that has completely banned plastic, and you're like, how do I work with them? But we're too small to be able to work internationally that way. So you just have to say, okay, keep the relationship going, but hey, we're not doing any kind of true business just yet. It starts happening. It's a lot of work, but it does start happening, and you have to just size it for who you are at the moment.
That's a great answer, and really helpful, I think, for the audience here. And another question I thought might be helpful for the audience to ask to our panel is just, and Sanjeev, maybe you can speak to this first before Kira, if that's okay. But just giving suggestions on how to get through the door to talk to investors. This person's been having trouble just getting conversations. So how do you get those conversations going?
Yeah, it's not easy, right? Kira mentioned 100 people that you want to get. These are 100 that are willing to talk to you. So to get the 100 to willing to talk to you, probably have to reach out to maybe 1,000, 1,500, right? And it's really leveraging your network. If you know another founder who, it's all about getting these interests. You can certainly do cold calls, where going on a website, they have VCs that have a process. You submit your material to them in a particular way, and they have a system to go through, and the ones that they feel interested in, they'll contact you. But you have to use again a multiple strategy approach, where you're leveraging your network, you're doing these sort of seeing which funds might align to your thesis, and you just have to reach out and not feel shy about that. And, that's how the doors are open. There will be somebody who will pick up the phone, who ends up writing you a check. But it's again, going back to the dating thing. You have to swipe a lot of likes to get a few that match with you. Just the nature of the game. I certainly it's, you get put through the ringer by that, and it certainly like bruises the ego. Like, why isn't this person responding to me? Why did they ghost me?
You're giving everyone PTSD, Sanjeev, from when we were all teenagers, okay?
Sorry?
You're giving us all PTSD from when we were teenagers.
Yeah. When I first started the company, I had hair. So now 4 years later, it's like all gone. But yeah, it can be very exciting, can be very frustrating. It just, you got to keep going and just keep knocking on doors. And everything I'm saying here is nothing new. I think most people have heard this, but it is true. It's just, you'll find the right match at some point.
And Kira, on your end, yeah, how does it work for you?
Yeah, I think, yes, persistence, it's a marathon, certainly not a sprint. I said this a little bit, like, you really want to do your best to match what those people are looking for to what you're offering, because that subset's out there. So if you start there, you're going to be in a lot stronger of a position. And I'll tell you, there's two ways that I'm going to jump in with somebody. One is, I said this, if you teach me something I didn't know about a space I'm looking at, I mean, hey, even if it's just to get to know you better and maybe see how I can help, even if I can't invest, that's one way. And two, if we have something in common, like some people have, because this is a human business. Business is about people at the end of the day. So, if you're like, well, gosh, I also started my career in product management and I'm doing X, Y, and Z in deep tech, like, or I do a lot with women in deep tech, there's a lot, it's like I can't say yes to every single overture like that. But the more you can have a direct connection that's authentic to the VC you're reaching out to, I think you'll find success.
That's great. That's great. Well, I think we have, yeah, we're basically at the hour here. So wanted to just really thank the panel here, Sanjeev and Kira. Really appreciate you joining today. Dave, thank you as always. Thank you to SOSV and everybody else joining for the summit. And really appreciated chatting with everybody. It looks like we may have Ned back on here.
Yes, I just wanted to say thanks to everyone, and especially thanks to you, Andrew and David, for joining us today, and to your guests. We hope everyone will take a look at the agenda for Climate Tech Summit. The rest of the week is very busy, lots of great sessions, both breakouts and main stage coming up. And we look forward to seeing you again. Thank you.
Thanks, everybody. Good luck.
Thank you, everyone. Appreciate it.